Hello and happy Monday, October 20th. My name is Nash Paradise, Director of Sales at U Mortgage. And joining me this week is my good buddy, Andrew Cady, branch manager, branch leader, all around handsome dude, super bike cyclist guy, and everything TikTok. Andrew, how you doing this morning?
Doing amazing, man. It's another Monday in paradise, baby.
It is over here. I mean, I guess living in Florida, you got better weather than we have here in Texas. It was like 40 something degrees this morning. It felt like, and it's going to get up to the 90s today. Like these spreads are not cool. I would like a little more balance here, but we'll take it. It's a happy fall day as it feels like 97 when I leave and have to start shedding some layers. But speaking of shedding layers, let's talk about what happened last week in our economic news. Nothing. We have all the layers. We've gotten rid of all the good stuff because we are still in a government shutdown. So what do we have to work with from last week? Well, we have lots of speeches from different members of the Fed. We have a really important speech from Powell that we're going to discuss here at the end of the show, how that impacts things going forward. The rest of the Fed governors have done a lot of talking and said some interesting things. And what we also had at the end of last week was a little bit of a kind of a banking kerfluffle, as Jamie Dimon, who when he speaks, people listen, the markets move. He is a CEO of Chase Bank, largest bank in the U.S. by deposit volume. And he was basically calling out other banks and some of their market share in their portfolio right now. And honestly, all about unsecured bank lending. So banks lending to other banks for unsecured loans, and how some of those have really come back to bite them. There have been significant write-offs. Some of the exposure, especially around things like subprime auto loans, have crumbled a little bit, causing some serious write-downs, and actually brought, what he said was, when you see one cockroach, you know there's a bunch of them. So he kind of alluded to a little mini bubble that's about to burst in the unsecured lending sector. Andrew, did you take anything away from that, or did you even hear about that? Did that make the news cycle in the non-nerd networks?
It made the news cycle. To me, it rings eerily reminiscent of what we saw. What was that, a couple of years ago with bank failures? Yeah. There's a lot that happens behind the scenes at these banks that I think the average consumer doesn't realize. And when we start to see extra risky lending, and we, like you said, cockroaches, there's going to be a couple analogies on this today. My favorite was Powell's analogy, which I'll touch on. But to me, I think banks, it smells of desperation, and it reeks of it. And when you start to see it, I mean, let us not forget Silicon Valley Bank went bust in a day. And if we start to see a banking bubble where we start to see banks start to collapse again, the entire economy is going to be put on notice very, very quick.
Agree 100%. We'll get into that a little later when we talk about Powell's comments. I just found it interesting that, the market reacted, then overreacted, and then kind of settled back down, but we'll see. Let's take a look at what's going on this week as we are impacted again by the shutdown. We do have inflation data coming on Friday. So you see all that red in there. That's all Friday. We got core CPI. We've got year over year core CPI. it's all expected to hang flat except the headline. The headline's interesting because the headline is what makes headlines, but it doesn't necessarily move the needle. So headline CPI previously was 2.9%. Projection right now is 3.1%. And so we're supposed to be showing a year over year increase in the total amount of inflation. Now, again, headline includes everything. So food, housing, energy prices, all in there. Should be going up a little bit. And I think once we cross that 3% threshold on inflation, it's going to make headlines. I think it's something that we're going to see a lot more discussion around, even though the year over year core has been steady at 3.1, the month at 0.3. Do you have any expectations of what we're getting into with the inflation numbers for Friday?
You said it perfect. The headline number is what makes headlines. I do think we see an increase. And I think it's, for those of you watching this, I think it's important to understand why we see an increase like this. What's more important than looking at the headline number on this particular month over month is looking at a 6-month average, because what we're dealing with this time is a very low replacement value. How these numbers work, the 2.9 to 3.1 happens because we are going to be adding in September numbers and then removing September of 2024. And that replacement value that we're dropping off is a very low value. So any increase at all is going to bump the headline up. And I think it's very important that we look at a 6-month average versus just a single headline number. But regardless, headline numbers make headlines. Markets react accordingly. We could probably see a rough day in bonds heading into Thursday. So if you're floating loans, make sure your clients are understanding that you're floating their loan, because that's not the right way to do business if you're not.
Yeah. And alternatively, we've got a lot of room to miss. We got room to miss low. I feel like the month over month headline CPI at 0.4%. I mean, that's pretty high. That's suggesting a 4% total inflation based on month over month if it was to continue for a 12-month cycle. Up in that 4+% range, that's really, really high. If headline comes in and it's lower than 3.0 with rounding, I think the markets are going to react because we expect this inflation to go higher. The tariff stuff was mostly transitory, as we've seen in the way that the numbers have reflected. But the good news is there's actually room to fail. There's room to miss. And with the lack of other data right now, we could see a pretty active marketplace on Friday. Could go either way. And I don't like to wait for Friday for anything, which is why I won't be floating regardless. But I will be watching intently to see how these numbers impact the market, and we could get some decent movement here either way. Which brings us to, what's the Fed doing?
Let me just add to it real quick. I think where we could miss, you're right, 4/10 is a big number. I think where we could miss is in lodging away from home, which has been historically high, very high. And these are September numbers. We know lodging away from home, Airbnb prices are at their absolute peak July and August. Why? Because people are getting the last minute summer vacations in before school starts. However, September, weather's cooling down up north. People aren't taking as many vacations, schools in session. And that's a huge weighted thing that we've seen really running gangbusters is the lodging away from home category. And we could see a big drop off in that, which could cause us to miss that 0.4% increase.
100%. Yeah, there's a bunch of important factors in there. I like lodging away from home being a market mover. It shouldn't move 10-year treasury yield significantly. But again, we're talking about bond traders moving billions of dollars, not necessarily thinking about, the long-term impacts that these numbers have on the economy, because some of these sectors are self-policing and will adjust themselves based on consumer spending and consumer sentiment. That's one of them. But, we'll see, and we'll go from there. And what does that mean for the Fed? What does that mean for where Fed rates are going? Let's take a look at this chart because, man, this thing has been wild in the last few weeks. We're now looking at, 99% that we're going to see a drop here in 9 days of the next Fed meeting. I would love to see the government open up before that. I think that'll be good for the data, but it doesn't really matter. We're getting a drop in October. And I think what I find fascinating is how we've gone back and forth all year on whether or not we'd have 2 or 3 drops this year. Now we're essentially 100% projection for the 12/10 meeting, seeing another drop. So much so that, it's 3% on the other side. I find it interesting that there's still some vote, some dots that are showing no drop in October, but everything is showing another drop in December. Your thoughts on that?
I agree. I think it's definitely an interesting mix right now. I mean, I think an October is a given. Now, here's the crazy thing, and we can say 100% certainty we're getting a cut in October, but one thing we don't know 100% certainty on is the actions of the individual Fed, and how that's going to work. All it would take is the government opening back up and getting one set of bad numbers, of really bad numbers that could just derail this entire chart. And you could see this go from 100% certainty to 30% certainty overnight. In the absence of data, which we're closing in on this 29th meeting very, very quickly with the government still shut down, I do think we see government open up in the next week. I don't think we're going to get any meaningful data in between that and the Fed rate cut. So I do think October's a shoo-in. We get that. December, there's a lot of time before December 10th. So I think, markets are pricing it in. But I think, we need to step back and be cautious on it. I do think it's odd that it's pricing in 100% for December and only 99% for October. It's who knows where they come up with these numbers.
Yeah, a little incongruent, but I think what this is projecting, what this is saying, if I'm reading this with my interpretation, is that the government will be open by then. We're going to see jobs numbers, based on ADP employment data, it should be pretty rough. And those rough job numbers are really going to put that pull into our, long-term projection here, which is that 275 to 300 range, which right now is projected, by September of 2026, which is pretty severe. That's another 3 moves next year. And to get us to that long-term hold range, which will be interesting when we finally get there. But that's kind of the long-term hold projection, is at 275 to 300 mark. How long does it actually take us to get there? Well, there's too much data in between now and then. I wouldn't be surprised, though, as we get into, December, like seeing a little bit of a pause. Powell's been very specific that they don't want to overdo it. People have been talking about a 50 bip drop. If the government opens up, we get information before October. We're not going to see a 50 bip drop in October. It's just not going to happen. But getting 50 bips between now and December 10th, like I said, 100% projection right now. And that's going to be a lot of drops in, 3 meetings. We need to give the economy time to adjust to that and see what happens after the fact. But, the takeaway here is we know where we're going. So it's already baked in. Any kind of surprises that we see aren't going to be enough, I don't think, to move the needle through the end of the year anyway. We could see things move for that January 28th meeting, but I don't think it matters if we drop in January or not, because by the time we get to March, we should see that first rate cut solidly. Again, here, 100% certainty that we've got a rate cut by the 318 meeting. I think that's going to be interesting, having all of 2025 spent waiting for that first rate cut, where now we have enough data to go off of in this post-COVID economy. We should be pretty firm on where we're going from here. All right.
I agree with you.
Let's talk rates, and I'm going to let you deconstruct this here and tell me what we're seeing.
I mean, what we're starting to see is so we had the big rate drop leading up to the next Fed rate cut. Fed rate cut happened. Jerome Powell took the stage. He blew the whole thing up like he always does. He very rarely says things that I agree with, but I'll touch on that in a second of something I really agree with. But now we're beginning to see the trek down as we see the 100% certainty leading up to the next rate cut. We've seen the 10-year break through significant thresholds, currently sitting, if we can pull charts up, the majority of the websites that are hosting charts, what are we at, a 3.99 right now? Which is a
3997 real-time chart on the
so breaking below the 4% threshold on the 10-year is a really good move. Leading up to the last Fed rate cut, we saw the 10-year Treasury drop exactly 25 basis points for a 25 basis point cut. Now, we retraced a bunch of that back up, but we're beginning to see it come down, and we are now down below the threshold we saw after the Fed did the cut. And so I do think we could potentially see, and some of the economists are talking about 3.6 on the 10-year. I don't necessarily see that, but I wouldn't be surprised if leading up to this cut, or at least the December cut, we see 3.7 on the 10-year Treasury, which, again, mortgage rates don't follow in lockstep, but I do think we will see mortgage rates fluctuate and then begin their trek down. I think we're in that downward cycle officially on rates, unless something really horrible happens in the market that would just derail it.
Yeah, downward cycle over a long enough term. I completely agree with you. And, we have been teasing that 4.0 yield on the 10-year treasury, which is a very important figure. When the 10-year treasury yields start with a 3, you're going to get some resistance right now. Do I think we can support a floor of 3.6? Yeah, we've done it before, but never for any significant length of time. It just takes until the next data cycle. And the next thing you know, we're up at that 4% mark. But what I'd like to get into on
I love where you said downward cycle, but Barry Habib has one of the best analogies for it ever.
Okay, let's go.
He said, just because we're in a downward cycle doesn't mean that every single day rates move down. He said, imagine you're playing with a yo-yo on a downward escalator.
Mm-hmm.
You're going to have days of ups and downs, but the overall trend is you're still moving your way down.
I love that. I had to go back to thinking about walking around malls and had to picture myself on an escalator. It's been a hot minute, but yeah, I mean, you got to look broad 6-month, 3-month cycles and see things dropping, but those day-to-days are going to be pretty heavily impacted. But right now, let's talk about where we're sitting. We had let's call it 4% on the 10-year treasury yield. You just said the mortgage overnight average mortgage rates are 6.23%. We're working with a 2.23% spread between the 10-year yield and the overnight average and the 30-year fixed. That yield is high. And that yield is high because markets are looking at the risk on the Fed's balance sheet and how much the Fed is holding on treasuries, how much the Fed is holding on mortgage-backed securities. So, Andrew, why don't you bring us into our subject for today, which is what Powell said about the quantitative tightening and the roll-off on the holdings from the Fed.
Yeah, so Fed Powell spoke last week. And we also, by the way, have Fed Waller speaking tomorrow, which could bring good information. But Powell spoke last week and talked about the Fed's balance sheet. The Fed has reduced the size of their balance sheet after they went on the biggest spending spree by the Fed in history, spent $2 trillion with a T in a 60-day window between March and May of 2020, and then continued to add after that. They have reduced their balance sheet by $2.2 trillion. It's a huge decrease. And when Powell took the stage, if anybody follows me, I rarely agree with the guy. I just rarely do. He said something that I really agree with, and I'll read it. He said, in his words, he said, talking about the Fed's balance sheet is compares this topic to a trip to the dentist. And I'm like, yes, it's that painful. Basically, the Fed's balance sheet, how they've been reducing it, they haven't been outright selling. And I know there's a lot of speculation of people, the Fed's selling. No, the Fed's actually been buying more than selling. But basically, when bonds reach a maturity, they're just not buying more. They're just letting it roll off the balance sheet. And Powell came out and talked about potentially letting treasuries stopping the runoff. Basically, when a treasury matures, buying an equal dollar amount back of treasuries again. That would significantly help the treasury market. Now, what needs to happen in the long term is actually start to roll off mortgage-backed securities as well. But he did make it clear that's really not the plan right now, which tells me Powell hates the housing. I'm kidding, but it doesn't make a lot of sense why you wouldn't why you wouldn't stop the roll off together. But even if we get just a treasury roll off, it is going to help treasuries. It's going to help mortgage-backed securities in the long run. And I think that's honestly probably the reason we're seeing below 4% on the 10-year right now is that commentary from Powell. That really, really helped the markets break through some thresholds. They're at what, 6.5 trillion right now, Nash? Is that where it's at?
Yeah.
Right, yeah, 6.5 trillion down from 8.7 trillion of holdings, which is a ridiculous number.
Well, I find it interesting that, a lot of people were speculating as to what is the Fed's long-term plan on its holdings. And Powell was very, very clear. We're not going to get down to post-COVID balance sheets. It is going to be inflated, which is fine. It's just the nature of how much money was printed, how much purchasing was done. Like, you can't go and adjust the Fed's balance sheet back down to where we were in 2018, 2019. He made it very clear that only holding that amount of treasuries would reduce their ability and significantly impair the Fed's ability to have any kind of control on interest rates. So cool, makes sense, checks out. For the layman watching this, basically every loan officer and anyone who doesn't completely nerd out, because this is high-level nerd stuff, what he's saying is the Fed has been letting things mature, not necessarily sell, and has not been reinvesting. So this roll off would be when these treasuries mature, is just going back and rebuying, reinvesting the capital to hold the balance sheet in place at the $6.5 trillion level. Those purchases will put downward pressure on the 10-year treasury yields, and therefore will have a positive impact on overall market interest rates as it relates to mortgages. What we really need is that reinvestment of mortgage-backed securities as well. We're not getting that anytime soon. Pre-COVID, we saw the spread between the 10-year yield and the average overnight price on mortgages around 1.2, 1.3, sometimes 1.4%. Right now, we're talking at 2.2%. That's still down from some of the highs that we've seen. So we look at that spread, and that spread is directly tied to how much investors are having to pick up the bill, basically, as the Fed lets these things mature and continues to sell off mortgage-backed securities. It means that it's completely a secondary market investors, and they're looking for a higher yield on return based on their overall risk assessment. If the Fed isn't buying MBS, they are willing to buy it, but at a higher spread. And that's why that spread is higher. As we get to the roll off on MBS in the future, which it could be a year away, honestly, based on what Powell was saying, we will start to see that spread narrow, and we've got room for another 30, 40 bips of narrowing there, and which is looking good for late 2026, even into early 2027. A lot of projections have, 30-year mortgage rates in the, 5.25 to 5.5 range. It would only take that combination of the Fed repurchasing their treasuries at a normal rate and ending the roll off on mortgage-backed securities to hold that combination of yield spread and spread between those two things.
Yeah. And it's important to understand that the Federal Reserve is the biggest purchaser of mortgage-backed securities and treasuries. They're by far and away the biggest purchaser. So when they have stopped purchasing, and then not only stopped purchasing, but then let the maturities roll off their balance sheet, that when that maturity rolls off the balance sheet, it goes to open market for someone else to buy. So they're actually reversing that role and flooding into the market. And so just simply stopping the roll off will significantly help. Now, if they would actually return to quantitative easing and begin buying again rather than quantitative tightening, we could really see things change. But I don't see that unless we have a true economic collapse.
Yeah, we're not going to get QE, but we'll take Q balance, which is a new term we just made up, if we're just keeping the balance sheet where it is. So with all that crazy stuff, high level over the head of most people, Andrew, what is that? I'm a loan officer. What does that mean for me? What can I share with people? How do I digest this and get this information to the people that matter? Like, what does it really mean?
To me, it's going to provide stability. The market is volatile. We know this. Like the swings. I mean, I long for the days of 2018 when we would see mortgage-backed securities move 3 basis points in a month. Mm-hmm. Like the market for years now has been extremely volatile. This will provide just another level of stability, and it will take some time to filter into the market. But I do think as the Fed stops the roll-off on treasuries, you'll see a level of stability begin to enter the market. Why? Because it's just going to take one more factor out of whether investors are going to scoop up what the Fed rolls off. And keep in mind, what the Fed rolls off isn't necessarily consistent on a month-over-month basis. It bases on the maturity of the bond. So 1 month might be a really big roll-off. 1 month might be a very small roll-off. Stopping that roll-off will at least provide a level of stability. So I think if you're an average loan originator, I think we're in for a good run. This isn't going to be another 2020 and 2021. We don't want that. That wouldn't be good for our market. It wouldn't be good to see home values drive even higher. We know things are overpriced. But I think if we can see just a general downward direction, and over the next 12, 24 months, see interest rates in the 5 handle. I don't even want to see in the 4 handle, but if we 24 months from now could have a 5.25 as an average fixed 30-year, it's a healthy economy, it's a healthy housing market. There's plenty of business to go around. I think the word I would use for the next probably get past the end of the year into next year is we see more stabilities in the markets.
I love it. And I think that's a great way to close this out. We've talked for years about where we expect things, where projections are. They weren't necessarily supported by a good why. Now we have a good foundation. We have something that we can lean on to say, this is why things should be slowly improving over the next 12 to 24 months. And, we're not banking on data that is wildly fluctuating, completely inaccurate and revised. We've finally got something going on that we've been hoping for a while. And it's a good reason to get excited over the next 2 years. So I appreciate all your commentary. I'm glad we're aligned on the nerd stuff. Let's get back together next week, hopefully post shutdown, talk a little bit about what happened with inflation and how that's relating. If you like it, lock it. Otherwise, check in with us next week and we'll let you know what's going on.
Take care, guys.